OpenAI is now thought to be worth $500 billion. If it was a public company, this valuation would place them between Netflix and ExxonMobil as the 20th largest company in the world by market cap. For a company that lost £7 billion in the first half of this year, with losses expected to grow, that's quite unprecedented. But does this mean that we're in a bubble that's about to burst? Or is this just a sign that we're in an evolving market and we should carry on as we were? In this video, we'll look at the case for each side and also what we can learn from comparing it to the dot-com bubble. In the first half of 2025, OpenAI made $4.3 billion in revenue. That's more than they are in the whole of 2024, but they also lost $7 billion. Their costs are rising faster than revenue because more advanced models require exponentially more compute. There just aren't the economies of scale yet. The race is so fast and the AI models are advancing quicker than ever, they're just tracking more and more computer power at it, rather than making it more efficient. Every time the model gets better, it costs them more money. The only way for them to operate is for them to continue to raise money. Following a recent funding round, OpenAI was valued at $500 billion. This allowed early investors to participate in a share sale. They'd authorized up to $10.3 billion in sales, but actually only sold $6.6 billion, with some saying that this is a sign of employee confidence and continued investor demand. We've also seen the likes of Nvidia pledge to invest up to $100 billion in OpenAI. And this creates a really interesting development because not only are OpenAI one of Nvidia's biggest customers, but Nvidia also doesn't have $100 billion to invest. As of July 2025, Nvidia had about $56 billion in cash or cash equivalents. But what's really happening here is that OpenAI needs to raise more money, and it also needs to continue to buy graphics cards. So it goes to someone like Nvidia, and it says, if you invest into our company, not only will you get shares in our company, but we will also take that money that you invest in us and give it straight back to you to purchase more of your graphics cards. So Nvidia could start by investing, say, $1 billion in OpenAI. OpenAI then takes that money and gives it straight back to Nvidia to purchase more of their graphics cards. They then repeat this 100 times. And therein lies your continuing investing loop. And that not only reinforces those inflating valuations, but it increases credibility. And it also means when OpenAI go to raise further capital, it's doing it at a higher valuation, which means its early investors and some of its employees can then sell their shares at a higher price. We've also seen similar deals with AMD and OpenAI, with AMD also supplying OpenAI with hundreds of thousands of AI chips, and also a deal for OpenAI to buy up to 10% of AMD's stake. And this one I found particularly funny.
One of the things that's going to happen in the next, it's hard to know exactly when, it's 10 plus years, but I bet it's not more than 20 years. We're going to start building these giant gigawatt data centers in space. So these giant training clusters, those will be better built in space, because we have solar power there 24/7.
Totally ignoring the cost and the energy needed to lift all of that stuff up into space and to keep it in orbit. Not to mention the difficulty in extracting heat in space. And it's because of these developing stories that now a lot of people are comparing this to the dot-com bubble, where share prices skyrocketed on not a lot of substance. There are a lot of similarities to that era, but there's also a lot of differences as well. So let's have a look at them. The first similarity is probably one that you've already seen, and it's that so many companies now are using AI as a buzzword. They're adding it to investor and marketing materials. And this echoes that dot-com era where every company was adding .com to their names. We can also look at the Schiller PE ratio, or the cyclical adjusted price to earnings ratio, which is currently sitting at 40.32, compared to a high in December 1999 of 44.19. However, unlike that period, this time we have got companies which are highly profitable, and their earnings have continued to grow year on year. We've also seen that most of the froth in the market right now is in those mega cap stocks, Nvidia, Microsoft, Amazon, where in the dot-com bubble, we were seeing hundreds of IPOs. I think a large part of people's concern is just how long this bull market has gone on. And I do think we could potentially be in a bull market inside a longer bull market. Since 2008, we haven't had a large market correction. We had a couple of months in March 2020 from the pandemic, and we had a slight correction in 2022. And since those bottoms in 2022, we're coming up now to 3 consecutive years of double-digit growth. But the fact the markets are at all-time highs, that in itself shouldn't necessarily be a concern on its own, because on average, markets are hitting all-time highs about 16 times per year. But one area that is quite similar is what the Fed did to interest rates. In 1998, the Fed decided to cut interest rates in what was already a long bull market. This meant money was cheaper, and this fueled the rise in those stocks. It was said at the time that this was potentially quite irresponsible, especially when the economy was still looking quite strong. Later in 2000, it had to reverse course and tighten monetary policy and actually increased interest rates. And it also is argued that this then contributed to the crash as well. I say it's similar because we have recently seen the Fed cut interest rates in an environment that has got inflationary pressures. Inflation is still above target. There is slight warnings in the labour market, but there's nothing really screaming that the economy is in trouble. There is a lot of political pressure for the Fed to cut interest rates, particularly because of the amount of US debt. And if we see the Fed continuing to cut interest rates, in an environment where it's not necessarily needed, that again could help to fuel a rise in some of these valuations. Of course, if it then did need to reverse course next year or the year after, that could be a catastrophe for the equity markets. I do think that's an unlikely scenario to happen, because even if the Fed do continue to cut interest rates this year, the Fed chairman Jerome Powell is expected to leave in May of next year, and is expected that he's going to be replaced with someone more politically aligned, should we say. Another big difference to the dot-com era is that the companies with valuations that are exploding are the bigger companies that hold a larger market cap, and they make the largest proportion of a lot of indices. They're also in a lot of pension funds and the wider investing community. And if there was going to be an impending crash or a bubble was going to be burst, I think there would be some pretty obvious signs. There seems to be a narrative that everyone's expecting a crash imminently. But if that was the case, then these valuations wouldn't be continuing to increase. I do think there are some clear warning signs that we could be at the start of a bubble, but some bubbles can last for years. And the most explosive growth is that towards the end of that bubble, just before it bursts. And that's what makes this so difficult. It feels like you can't afford not to be in the market right now. The dot-com era is fascinating because it was the right technology. It was the technology of the future. It was just the wrong time. It wasn't until the age of the smartphone that the benefits of the internet really kicked on. And I wonder whether something similar is happening with AI right now. We know it's the technology of the future, but are we ready for it right now? And have we got the infrastructure in place? I do think there will be an increase in productivity with AI, and they will become more efficient in how they process data. But the growth in these data centers and the amount of energy that they use is just so explosive right now. A really interesting area of growth that I see in the next 10 years is going to be the uptake of these SMRs, small modular reactors, these small nuclear reactors that can power these data centers. You've got a low-cost, clean form of energy that can power these data centers. They can be built on site, and eventually they can be built at speed and scale. A lot of this also depends on your age and time horizon. If you're in your 20s and you've got a really long time horizon, even if you invested at the peak of the dot-com era, you would still be well up on your investments right now. Yeah, it may have taken you a while to have seen a positive return, but the idea of having that long time horizon, it doesn't really matter when you enter the market. The most important thing is consistency, and of course, when you exit the market. Now, it's very different if you're in your 60s and your 70s and you've accumulated wealth over your lifetime. Then of course it does make sense to slightly reduce your exposure because you want to protect your wealth. So a lot of this is going to be unique to your individual circumstances. So are we at the start of a bubble? Probably. When's it going to burst? No one knows.